Okay. I think I left a. Oh, yep, that's for you.
Yep.
Here's your advance.
Thank you. I'm going to set a timer so I don't talk too long.
Oh, that's all right.
Yeah, this presentation is sort of designed to keep going as long as we want it to go, so timer makes sense to leave some time for questions at the end. Thanks for the introduction, Doug. Thanks for having me here. So Doug and I talked about me speaking about financing the emerging enterprise. So the thought here is that a good portion of people in this room are inventors, and you might want to take that invention and build a company around it. And how would you go about financing that? Lots of different ways to finance a company. The ways, sorry, this seems to be working. I'll get to it in a second.
You may have to click on the presentation, and then I'm hoping. Here, let me help.
Yeah, maybe if we went off the.
It was working. Yeah, just click in
So
here.
it's in read mode now. Let's see if that.
Is it working?
See if that does it. Yep.
Okay. Good.
Okay. Yeah. So when you're financing your venture, I mean, you can obviously do it yourself and bootstrap the venture. But putting that aside, you might reach a point where it's time to take on a partner. And when you want to take on a partner, the partner is going to want to see certain things about the company, certain things about your business plan, certain things about your ideas, where it's going to go, the size of the market, things like that. So at that point, it's time for you to figure out what you want before you go out into the market and start speaking to different partners and different people. You're going to figure out, what's important to me. What's important to me? Do I care about giving up control in exchange for capital? Am I the kind of person who's going to need to maintain control? How much money do I need to take? How much money do I want to take? How much dilution am I willing to take? These are the kind of things that you're going to be considering. But part of it's going to be around what you're able to do and what your actual venture is. If you're limited to an idea stage and you're just trying to get to a proof of concept, and really all you're going to need is $50,000 to $100,000, that's going to produce a different kind of investor than someone who's got a big idea that's going to need to ramp up and need $5 to $10 million in the next year. So these are just the sort of things that you need to think about, and will dictate the kind of investors that you're going to be talking to. And then beyond just the kind of investors that you're going to be talking to in terms of dollar size, you're also going to want to be considering the kind of investors that you're going to want to bring on board, and what you have and what you don't have. Do they have access to networks that you don't have? They have access to resources, distribution channels, things like that. So these are all things to consider when you're going through. People talk about the venture capital world, and I spend a lot of time in it. And when you're talking about venture capital, you're probably not talking about investments that are any smaller than $500,000. You're probably talking about investments that are coming in from a partner that's going to put anywhere from $500,000 up to $100 million into your venture. And in that venture, what they're going to want is they're going to want to be your partner. They're not buying a piece of the company from you. They're buying a piece of company from the company. And they're putting money into the company so you can grow that company. And they need to buy into your business plan and what you're going to do. Part of that's buying into the idea. Part of that's buying into the management team. Part of that's buying into your business plan. Part of that's buying into how much money you think you need to get from point A to B, because there's lots of inflection points along the way. And what we're really talking about with inflection points is we're really talking about your value. So if today your company is worth $100,000 and you think it can be $1 billion company, that turning into $1 billion company, there's a lot of steps along the way. That might take 3 years, it might take 5 years, it might take 10 years. So you have to figure out what those inflection points are and how much money you need to get to each one of those in order to figure out where you should be heading with the company. So if you have an idea right now and you need to build a beta version of it, and right now you think that idea on its own is investable to the tune of maybe $100,000 valuation. But you think once you have a beta product, that company is going to be worth, it's going to be part of, it could be in a company that's worth $1 million. Well, think about how much money you need to build that beta product, get to the point where the company's worth $1 million, and then raise money again at $1 million. But you don't need to finance the entirety of the project on day one. So when we're talking about valuation, we're talking about a host of things. We're not only talking about the idea itself, but we're talking about what else you've built around it, the infrastructure that you've built around the idea. Have you protected that idea? Have you built out a team? Have you identified a team? Have you identified a market? Can you do it alone? Do you need help? Who are the advisors? Who are the people who are around you who are going to be helping you with this? Or who are the people you need to help you? And if you factor all of those things in, really all you have is a story. You still don't have a valuation. Getting to a valuation is really, it gets said over and over again, but it's true. It's more art than science. You could take all the different factors that you might learn in business school around how to value a company, and none of it really applies when you're at an early stage and you're a pre-revenue company with an idea. So you're really looking at the market and what the market might bear. So you're looking at comparable companies that have been funded in the private markets, and in order to do that, you need information. So you can be looking in the trade papers. If you have advisors who have access to subscriptions to services like PitchBook, things like that, you can get information on companies that have raised capital in your space. And then when you're talking to a potential investor as to what your valuation is, you're not only selling the story of who you are, but you're talking about how your company, how the market's been pricing companies like yours, and really why your company is better, or your idea is better than that. I want to pause on valuation for a second, because you'll hear a lot about it, and I want to talk about what it actually means when you're really getting into the finances of it and the legal aspects. When you're talking about a pre-money valuation, you're talking about your company as it exists today. So in the example up on the screen, we have a company that has a pre-money valuation of $1.5 million. And there's, in the example here, and I think so we have 600,000 shares in our company that are outstanding. That means that the current owners of the business, prior to the VCs coming in, own 600,000 shares of the company. A pre-money valuation translates to $2.50 a share. When the new investors come in, they're going to buy new shares at $2.50. So for their $1 million, they're going to get 400,000 shares. And at the end of the day, your pre-money valuation of $1.5 million plus their $1 million investment means you have a $2.5 million company. That's as basic as you can. That's as basic as it gets in terms of valuation. Where it gets more complicated, and it can get more complicated in many different ways we'll get into, with different rights and preferences an investor can take. But the first place it gets complicated is when you handle the option reserve in a company like this. Because what an investor will typically say is, this $1.5 million pre-money valuation not only includes you, but it includes the option pool for the employees that you're going to need to bring on to build this vision. So in the next slide, you'll see what we have here is the founders only have 450,000 of these shares. They've reserved 150,000 shares for new hires that are going to come in, and that's the 600,000 shares, and that's where the pre-money comes in. So when the new investors come in and they take their 400,000 shares for 40% of the company, and they're buying it at $2.50 a share, that's what their price is. Your shares, your 450,000 shares, are actually worth something less. So in terms of sources of capital, we're going to spend a lot of time in this presentation focused on the traditional VC investment. We'll talk about preferred equity. We'll talk about convertible debt. There are many other sources of capital, and there are many other ways to raise capital within these sources of capital. Here's a chart. The deck is available over on the table over there if anyone wants to take this home. I think there's also, Doug, you're also doing this, taping this as a webcast as well.
Yes.
So I'm not going to spend too much time going into the pros and the cons of each of these different sources of capital. But we talked for a second about bootstrapping earlier, which is great if you have the money and you can afford to do it. An even better way to do it is to get the government or someone else to flip the bill in non-dilutive funding through some type of funded research. But if those aren't options, then you're kind of moving into private venture capital, and that comes in all different shapes and sizes: friends and families, angels, organized groups, crowdfunding versions of those, private placements, different state-funded programs. There's a few of them that are listed here, but in the state of Connecticut, I heard someone mention Connecticut Innovations earlier. DCD is another funding source, but Connecticut Innovations has a slew of different options for financing emerging growth companies, starting really with they have matching funds at $150,000 if you can come up with somebody who will invest $75,000 and they approve you for it. So that's really a great option for being able to get some capital in the door. And then as the company grows and gets more institutional venture capital, the numbers get bigger. And as a company matures, there's different options that can be available to you through more traditional lenders. IPOs. So we've been talking a little bit about the types of investments and what's going to be available to you. It's important that you choose your investors wisely as well. Your investors are really, in one way or another, are going to be your partners. Even to the extent it's the government, the government's going to make a grant, and it's going to be a grant around you doing certain things. If it's a VC, they're probably going to want all kinds of rights, and that's sort of one end of the extreme of what what a real partner could be and what it can mean. And being careful would be the venture capitalist that's going to come in, that's going to sit on your board, that's going to demand consent rights around certain things. But even when you're dealing with angel investors, if you're issuing convertible debt to angel investors, they're now debt holders in the company. Debt holders have rights in the company. When that debt becomes due, they're going to have rights to that capital. Or even if you're thinking, well, I'm just going to sell common non-voting equity at valuation to my friends and family, the second you take in money and you have other shareholders within your company, you're going to start having fiduciary duties to those persons. So you're going to have partners. Once you take in capital, it's not all you. So that's something that's key to remember. That being said, most people can't do things alone, or at least come away and build big ideas alone. You can you can come up with a big idea and maybe find somebody to buy that big idea. But if you want to build a company, if you really want to build a business, you're going to need some partners in some way or another. So you want to choose them wisely. So when you're choosing them, you should be thinking about a number of things. A lot of it's going to depend on what you want to build and who you are. Some of it might depend on that individual or that entity that's investing in you, their ability to continue to invest in you and to continue to support you. It might depend on what their stated interest in with you. If you're building something that you're hoping to turn into $1 billion company, you probably don't want to align yourself with investors that are looking for a 10% return after a year. You're going to want somebody who's in it for the long haul, that's in it to kind of have the big outcome that you have. You're going to want somebody who is supportive of what you're trying to do. And if you're someone who wants to be challenged, you're going to want somebody who's going to challenge you and be a checkpoint for you. If you're someone that is an ideas person but doesn't really have that much experience in raising other capital or running a business from a finance perspective, you might bring in somebody who can also act as a mentor and help you with that. Finding those people and finding the right people isn't easy for most people. You can find people through your friends and family if you're lucky. If you align yourself with groups like this and go to different networking events, you might happen to run into the right person. But really, it's just a matter of building your network, because the bigger your network is, the more likely you are to find access to the right people you need to take your company forward. And your investors and who you choose as your investors really can be a great way to access that network and access new networks that you might not play in normally. The value of networking itself is good not only for finding those partners themselves, and from working within those partners' networks, but it's also important for finding that next thing. Once you've got the money in your company and you're ready to build it, you're going to need to spend the money as your business plan calls for, and that might require software developers. It might require lab technicians, and having access to those people and networking to find those people is really going to be key to growing your company. And a lot of these access points to these people are available to networks that you guys are a part of. I heard Doug say earlier, mention that IACT has the annual party with CTC and CVG and those groups. Those are all great local networking organizations that bring something else to the table. They'll kind of work together. I think the Angel Investor Forum is part of that group. So you've got angel investors who show up at that annual party. You've got the Crossroad Venture Group, which is full of venture investors and service providers in that space. I think Connecticut Technology Council is involved, and they've got access to lots of the different technology companies in the state. And that's just locally within the state, and the ecosystem expands from there. So the venture transaction itself. So let's assume that you've gotten to the point where you've built out your network, you've built your company up to the point where you've gotten that seed financing, that $50,000, that $100,000 that's gotten you to the point, and now you're looking to really raise venture capital. And you're looking to do your Series A investment, and let's say you're looking to raise somewhere between $5 and $15 million in your Series A. It's not, even if you've gotten to the point where you've done all this, it's not like you snap your fingers. Even if you've met your investors and you know your investors are going to be, there's still time that goes into it, and you might receive, there might be numerous meetings that go on before you even get to a stage where you have a term sheet from an investor. And then once you have that term sheet from the investor that lays out the terms of the investment, there's still time that goes on between signing that term sheet and actually closing on the money. And there's negotiation that's going to go along with it. So the kind of terms that you're going to see that you might not be familiar with it, we started this with an example of a $1.5 million pre-money valuation company where you had 600,000 shares outstanding, and the investor came in and put $1 million in and bought 40% of the company. That $1 million is typically not the same as your $1 million. It's going to have different rights and preferences. It's going to be a highly structured transaction from a financial perspective, to give your investor as much downside protection as possible, while at the same time there's going to be some level of control they're going to want. And maybe that's taking a board seat that makes up a minority of the board, depending on the size of the investment or who the investors are. They might want to control a majority of the board. In all likelihood, they're going to want to have some kind of protective provisions over the major actions that the company takes. So, you can't, no matter what, you can't sell the company without our consent, or you can't raise capital without our consent, or you can't take on debt over a certain amount of money without our consent. These are the kind of rights that would be typical for an investor to take in these situations. And you, as the founder of this company, is going to have to make a decision as to, who you want to be and what you want to do with this company. And typically, I'd say more often than not, the right answer is to align yourself with a partner that can get you there. But you need to go in with your eyes wide open and realize that you're giving up a lot of control in your company. So you might end up trading some amount of valuation for control. Some people want high value for their company to maintain a lot of their equity. That's great, but there's only so much you're going to get in a negotiation. So you've got to decide what's important to you, and to the extent you're giving up control, who you want to partner with. So I also talked a little bit about this process and how long it takes. I find that a lot of the clients that we work with, a lot of the entrepreneurs don't realize that if you need to be raising capital, you need to be looking for that capital 9 to 12 months out, because even once you're getting to the point where you're meeting with investors and you've got your pitch deck ready to go and you're closing in on that, you're still looking at a half a year more often than not before the money's actually in the door. So it's a long process. And with that in mind, when you're raising capital, you should be looking to raise capital that's going to last you a long enough time, so you're not constantly just out on the road raising capital and you're actually running your business. Yeah, so when you're taking these investor meetings, we've been talking about making sure you have the right network and making sure that you meet the right partners. It's hard. It's a hard process, and the easiest way to do it is if you can get referrals from people. It's an introduction through your network is going to be much better than you cold calling an investor who may or may not return your phone call or your email. So you want to be pretty targeted, but when you have the opportunity to do it, you don't want to blow it either. So you want to make sure that you're getting the pertinent information out to the investor that they need to know whether or not they want to keep speaking to you that next time around. And that's either through your elevator pitch, where you have 30 seconds to get your idea and your business out in front of them, or you've got the one-page version of your business plan that leaves the 25 to 75 pages behind, because they're not going to read it that first time around. So it's very targeted, it's very careful, because you're all busy people and you don't want to waste your time having hundreds of meetings that aren't going to actually go anywhere. So I think we've covered a lot of it. Yep.
So in your position, you know both the people with the money and the people who want the money.
Yes.
Do you help to connect those people together?
Yes. Yeah. So I guess I view my position as being part of the network, and I think choosing the right service providers, accountants, lawyers, financial advisors, can help bolster that network. So in my practice. And Doug, you gave an intro, but I'll give a little bit more about the practice, about the firm. So Wigan & Dana is a full-service law firm. There's about 150 of us. We do all kinds of things. I mean, my practice group that I run, there's probably 25 to 30 lawyers in it, and it kind of crosses over a lot with our M&A group. But just from the transactional side, we have life science lawyers, we have intellectual property lawyers, we have IT and outsourcing lawyers, we have on the litigation end, we've got, also intellectual property lawyers. We have franchising lawyers. We've got a huge network of people who are doing lots of different things. So we have lots of different clients. Within our group, we probably represent 25 to 30 different investors. But we probably represent at any given time about 125 companies. So we tend to be more within the group on the issuer side more, but we're involved in a lot of the organizations or the universities from New York to Boston and outside of that corridor. So we just know lots of people. And I'll often find myself having lunch with an investor who I don't expect to ever do any work for. But the reason why I'm having lunch with that person is to kind of keep the lines of communications open so they know who we're representing, because when our clients get funded, that's good for us, that's good for the ecosystem, that's good for everyone. So it's not unusual at all for me to make an introduction to a potential investor for a client. What I do say to my clients, though, that when they do that is I want them to give me something polished that I can present to the investor. And something that is a 1-paragraph description of what I need to tell them about the opportunity and a 1-page description of the investment itself to put in front of them. So that way, they can give me a quick yes or no on whether or not they want to meet with someone.
What about nuts and bolts in terms of deal with any papers, stock certificates, investor relations? Do you, in a particular company, do people get quarterly updates or milestones? And who does that?
Yeah, so, well, the quarterly updates is usually something that the management team will handle. I mean, the investment itself in connection, so from the lawyer's perspective, when we're representing a company on the actual investment, we're representing the issuer, we're negotiating the stock purchase agreement, all the investor rights agreements, everything, all of the different transaction documents around it, and at the closing, we'll deliver stock certificates to the new investors. Going forward, we act as corporate counsel. Oftentimes, we'll continue to keep the stock ledger. More and more of our clients are actually moving that function of keeping the stock ledgers and the transfer and issuance of shares on a day-to-day basis to online platforms.
So we'll be all, typically it's going to be electronic transfers of certificates and documents.
So I'd say more and more it's becoming, with the privately held companies are moving more towards the electronic transfers using systems like Carta.
In terms of time spent with investors, I suppose if there's just one major investor versus 20 or 30, and people start asking questions, you're better off with fewer.
Yes.
Or,
yeah. Look, you're so I'd say fewer investors versus more investors. It depends on how. When you have a few, it depends on how much you like them. I'd say on the way in, on the investment side, where you've just chosen the investor and you're in this honeymoon stage, it's much easier. It's often much easier to get a deal done with one person on the other side of the table than it is with 20. Sometimes the 20 are pretty easygoing and they're your friends and family, and you can kind of dictate the terms. So there's other times where that's easier. But when things get rough within a company, and the founders aren't necessarily getting along with their investors, I think they are oftentimes be happy to have a more diversified investor class where they can appeal to different folks.
yeah, I'm thinking of maybe 100 investors put up $5,000 for $500,000 of like late seed development or between seed and round one. What sorts of problems might come up then? Would you possibly give each of the 100 investors the same conditions of investments? So they're essentially not 100 bosses.
Yeah, well, so you'd have everybody act with a certain percentage. So you would give everybody the same terms, and you would treat them as a class,
Okay.
or you would typically do it. I mean, there's more than one way to do everything. You mentioned $5,000 investments. I would usually tell a client not to take on an investment that small.
Why?
It's not worth the trouble.
Okay.
Yes.
Do you represent anybody that does anything to do with consumer products?
Sure.
And do you deal with any consumers that deal with seed funding?
Sorry?
With seed funding?
We do lots of seed funding. But you mean that the company itself does seed funding, like a crowdfunding operation?
Yeah, like say I was an inventor and I needed seed funding for a consumer product. Do you represent any people that deal with things of that nature?
Yes. Yeah. No. So when we're talking about these different types of financings. We've been talking about preferred stock for the most part. You do preferred stock when you have a pretty good idea what the value, or when you can agree on what the valuation is, and you can agree on the valuation at a seed round. There's no reason why one couldn't do that other than it's just hard. It's hard to gauge a market for it. It's easier to gauge a market for what a company is getting valued for as the company moves a little further down the line. So what you often see in seed financings are different types of convertible equity instruments, whether it's convertible debt or it's a KISS instrument or a SAFE instrument, things like that. But yeah, we do that often.
And is your percentage, is it an upfront fee or is it per?
So most corporate lawyers don't act on a commissions basis like that. For the sort of the standard billing for a corporate lawyer and getting these kinds of things done would be to bill at an hourly rate. More and more for tasks that are sort of defined, predictable, and reproducible, you could negotiate a fixed fee for certain of these things, especially when you're talking about like formation things or pretty simple seed funding mechanisms. But it's something that we do often. I mean, in my practice, we work with people who are really at the idea stage all the way through to exit. So I mentioned that in our group we're probably representing 125 companies at any given time, just by nature of the way companies grow and die along the way. The majority of them skew towards the early end, and the few that keep us busy are at the later stage.
Getting back to raising $500,000, if you had 10 investors put in $50,000 apiece, and they wish to sell interests to each other, would that require being registered as a broker?
Is anyone taking a commission?
The intermediary would be, I suppose, the law firm, which would possibly be deemed a commission.
Yeah, so I don't know. I'd have to look into this specific situation, but I'd say no. On the basic facts. I mean, it's what you'd usually do is you'd have investors, and oftentimes the investors have permitted transferees whom they can transfer the shares to, and sometimes they do include the existing investors. But usually what you would require in order to make a transfer of your privately held stock is for the transferor to get approval for the board, and oftentimes the board's going to be permitted to seek a legal opinion from the transferor's counsel as to why it complies with securities law.
So that would possibly be a rule included in the original stockholder agreement.
Yeah.
What you do if you want to transfer Mr. 1 to Mr. 2.
Exactly. So we talked a little bit about this. I'm not sure how much anyone wants to get into specific terms. This is sort of the extra portion of the presentation, and we can double back on it. I guess what I do want to talk about for a second, because we spoke a bit about valuation, is convertible instruments. Because I mentioned it, but I'm sure not everyone's familiar with it. So in our earlier example, where we said the company had a pre-money valuation of $1.5 million, and the new investor came in and took 40% of the company for $1 million. What made that okay is we all agreed that the company was worth $2.5 million. Oftentimes, parties can't agree at that stage, and when you're talking about investments that are under $500,000, usually the parties that are making the investment aren't really in a position, or aren't really, I don't want to say that they're not financially sophisticated, because oftentimes they are, especially if they have $500,000, but they're not always in the position to understand your company well enough to really put an appropriate valuation on the company. So what in seed investments, what often gets done is the investor says, look, I want to put $500,000 into this company. You and I both don't know what this thing is worth, but we know that it's going to need $500,000 to get to it next year when we're going to raise $5 million. And when we raise $5 million, we're going to be talking to sophisticated venture capitalists who are going to come in and they're going to turn this company inside out and they're going to tell us what it's worth. So let's agree that I'm going to give you $500,000 now. And when that investment comes in, my $500,000 is going to convert into their investment. So we're going to cancel my debt in exchange for the stock that they're buying at that time. So that's sort of in its most basic sense how convertible debt or a convertible equity instrument like a SAFE would work. Now, there's a bunch of different wrinkles to that because if I'm the investor, I say, okay, so now that we've established that, I'm giving you $500,000 and the company's clearly worth less today than it's going to be worth next year. So when I convert, I want a discount. So I'm going to convert in with a 25% discount, a 30% discount. Or I'm giving you this money now and I can't use this money, so I'm going to take interest on it, 5, 10, 12% in interest because it's high risk debt over the next year. Or you'll get into capped valuations where someone says, well, we can both agree that this thing's not worth more than $5 million today. So next year, when you raise money in a financing that we deem a qualified financing, I will convert my debt into equity at a 30% discount, and my debt will have accrued 10% interest along the way. But if for any reason those people come in and give you a valuation that's any higher than $5 million, there's a ceiling to the price per share that I'm going to pay. I'm not going to pay any more than the equivalent valuation of us at $5 million. So that's what people are talking about when they're talking about convertible debt. Yes?
Did you tell everybody what SAFE and KISS stood for?
I did not. KISS is Keep It Simple Security. And SAFE is a
Simple
agreement for future equity. Yeah.
I had to look it up. So.
Yeah, so those instruments, so I'll kind of historically on this. So like what I described to you in terms of the convertible debt initially seemed really simple, right? It was you put in a certain amount of money and next year we figure it out. So like, I don't know, 25 years ago someone came up with that idea and that was meant to be the way to get early stage money in. What's happened since then is investors, earlier stage investors have become more sophisticated. They've added in discounts, caps, board seats, all the stuff that made the investment simple went away because sophisticated investors got their hands on it and started muddying it up. In the last 4 or 5 years, 2 incubators out in California, the Y Combinator with the SAFE instrument and 500 startups with the KISS instrument tried to pull it back again. And they said, you know what, I've got the idea. Here's a form document. We're putting it up on our website. Any company that wants can take that document and use it with their investors. It's a non-negotiable form document, and it should be good enough for you, and it should be good enough for your investors. What you're seeing now, since those went up, people are starting to negotiate those and make those, those non-negotiable documents negotiable. There's some differences beyond that too. So a SAFE instrument and convertible debt seem a lot alike on their face, except the SAFE instrument doesn't have interest and never matures. So it really only gets repaid. It really only gets converted or repaid on an exit. So it's caused a lot of the accountants that I know a lot of trouble trying to figure out whether it's debt or equity. And when a company is circling the drain and has SAFE instruments outstanding, there's a lot of people trying to figure out what the priority of the SAFE instruments are in the bankruptcy waterfall structure. So it's not a perfect instrument, which is why I think 500 startups then developed the KISS. So that is. So I time myself so I still have 50 seconds left. So I can either start questions earlier or we can double back. If anyone had any questions about some of these terms on the preferred equity, I'm happy to talk about that as well. Yes.
What sort of batting average, maybe does your firm or maybe the local area, in other words, how many of these companies are financially successful, and I often hear things like, well, if 1 out of 10 is good and 2 or 3 are okay, and half of them are wiped out, then the second part of my question would be, what happens to the entrepreneurs in businesses that don't meet their numbers?
So I'll take the first question first. Yeah, I mean, look, in terms of success, everyone's going to measure success differently. I've seen lots of companies claim successful exits where they've returned 5% on their initial investors' capital, or even 10%, but their initial investors were putting that money in to try and get a 10, 20x return. I've got a client right now that's up for sale that their investors are going to get a 7x return on their money that they put in a few years ago, and the investors aren't thrilled with it because the investors wanted a 30x return on their money. So it depends on who you're asking. Now, if you're talking to the entrepreneur and the entrepreneur just wants to, so when you're talking about somebody who's developed a cancer drug and their success is whether or not I can get that into the hand, develop that to the point that I can get it into the hands of someone who can take it to market, then they're going to define their success differently. If your success is based on like, look, I built this company up to a 100-person company that had $30 million in revenues, but eventually, like, we ran out of capital after 10 years and our investors got very little return. Some people might view that as a success, but from our perspective, we're not equity holders. So we really, the longer a company can stick around and need legal services, that's a success for us, right? So it's everybody's got a different view of what a success is. But if you're looking at it that way, you're talking about it more like from the venture capital perspective, where the VCs, they expect to hit a home run probably 1 out of every 30, and then they need to make they need, well, maybe more than 1 out of every 15, and then they need the rest of them to be either okay or not failures, so they can tell their investors on an annual basis, we're providing a 2x return. But it's a portfolio approach. And it's the same thing with us. I mean, we've got clients that, that are we only bill a few $1,000s to a year, like we can. That's not how we're paying our bills. Oh, sorry, actually, you had a second part to your question.
A lot of times investors will buy into an idea and a business market opportunity, and the entrepreneurs might be very good in the early stage idea part of it, but may not be managers or may not have the ability to have the background necessary to raise additional money at the level that will be needed and whatever. And it seems like, that the person, say, who came up with the idea, they might be a very good an engineer or scientist, but they may not be a manager. So then there's a conflict there.
So the trick is, when you're figuring out who those partners are in the beginning, who you're going to be bringing in, is really to know your limitations. Where I see companies getting into the most trouble are when somebody who's a doctor or a techie or scientist that thinks they're also better than they are as the CEO of the company. If you've got real investors who've invested $5, $10, $20 million into your company, they've got a vested interest in seeing that through. And oftentimes they want to remove that person and bring somebody in. And most investors are willing to bring somebody in and pay them $300,000-$400,000 a year to run the company that you've developed. But at some point you need to know your limitations, and you need to know it's time for you to step aside, and the company needs you to get out for that next step. There's plenty of success stories for founders and CEOs who didn't move out of the way and did it their own way, and made that success. I think there's more who got out of the way and went down on the cap table as a founder with 20% of the company and collected their check at exit.
How do you help people with SBIR money?
So we don't usually get involved in the actual grant writing process. It's usually not cost efficient for us to be. I mean, we'll review them to make sure people have things in the right place, but a lot of our clients do. I had one client this year, I think he's raised $8 million in SBIR funding this year.
Did you help?
No, I mean, I helped him with lots of other things.
No, because I've gone and I've applied for secretive contracts,
Mm-hmm.
but the people didn't grasp. You know, you have 15 minutes to explain something to somebody. In 30 years, I haven't found a person yet, maybe 2 people, that comprehend what I've come up with. And proven, they did not just come up with that, proven it.
So there are some people who are particularly good at translating those ideas and getting the government and figuring out what the government wants in order to be able to get you to fund those ideas.
Yes.
I think those people, and I'm sure there are some lawyers who do it, but typically they're grant writers.
There's universities up and down the Boswash corridor that have used their technology to start companies, and some groups have a product. What might be a constructive way to get involved with those startups, given that they have a product and given that you can come up with some accredited investors who would put money in? Accredited investors who have not yet been vetted as accredited investors, but who at least say they are.
Yeah, so when you're talking about accredited investors, unless you're out there raising money through a general solicitation and sort of a crowdfunding platform, when you're doing a typical private placement, self-accreditation is still okay. But when you're talking about, if you have access to capital and you have accredited investors who want to put money in, most startup companies will talk to you. And if you want to get involved at universities that have tech transfer offices to fund those companies that are coming out of them, most of those universities are more than happy to have people that are willing to fund those companies hanging around. I mean, to approach the university itself, so we'll use Yale as an example because it's the one I deal with most from a tech transfer standpoint. They'll have VCs that come in and identify a technology, identify a researcher that is an inventor, and a researcher has developed that technology, and build a company around that technology and hire that Yale faculty member to be a consultant of some sort and give that faculty member a certain smaller percentage of equity in the company. But really, they'll build the company. They'll put in they'll build the management team from the ground up. That's one way to do it, but that's when you're talking about putting in, $5, 10, $15 million. If you're talking about more angel investing, those same tech transfer offices have plenty of faculty members that don't have a VC banging down their door and want to build a company. And we work with a lot of different faculty members that get referred to us by these tech transfer offices that want to take the technology that they develop and in-license it from the university in order to build a company around it. Those people don't want to bootstrap their ideas. So I'm sure that if you got involved with those tech transfer offices as somebody who might be interested in funding some of these companies that spin out, they'd be more than happy to let you into their network.
And possibly the technology transfer office could put together a PPM to give out to the investors, or are they not that?
They're not doing that.
They're not doing that.
Yeah,
You guys do that.
we would do that. But somebody's got to identify the technology and build the company.
Yeah, I'm talking about companies who actually have a product and had some financing and are in kind of.
So you're talking about a company that has licensed the technology in the past and has built a product around it and is now.
Well, it's still, the university's still got their hands in it. The university has put the startup money in. Specifically, I recently was down in Charlottesville, Virginia, and I see that the university put a $10 million fund up, and I think there's 5 or 6 companies that they've up and running now.
Mhm.
And I'm wondering what the next stage in growth, is for those, 'cause,
So locally, there's something like that where I think Yale, UConn, and Connecticut Innovations have created through their bioscience fund, basically $500,000. I don't know if they're grants or investments into ideas, into concepts to try and build a company around it to see if it gets to that next stage. But those are that's a local example of it. I mean, as far as but what's missing there, or the next step for that, is for someone to grab that product, grab that concept that's now been developed, and to build a company around it.
Yeah, that's sort of where I'm talking. The next step over actually sort of, angel obviously is, kind of not specifically defined, but I guess stage 1 starts at $500,000 to $5 million.
Well, they need somebody
Before
they need an individual who can actually, who's going to stay with it, build it, and the university is not in it for the return on capital as much as they are for notoriety for their faculty, notoriety for their technologies, to get the technology out into the world. So for them to allow a private company to license the technology that they own, they need to see a nice business plan that'll allow that technology to get off the ground, and they still have to have the ability to claw it back if you don't.
I'm just thinking of in medical devices and medical testing, the typical thing in a yearly checkup, someone listens to your heart and they take a blood sample,
Mm-hmm.
and then beyond that, that's where Theranos was.
Yeah.
And I actually wondered how those errors couldn't have gotten by so many people.
Yeah, I can't speak to that. That's kind of a debacle.
But the bottom anyway,
What advice would you give to an entrepreneur who has the prototype, they have the business plan, they have the one-page summaries, they have everything to present, but they don't have they don't have the resources that, to reach out to somebody that can introduce them to someone else, and they haven't.
So you can get the resources by showing up to events, by networking, by engaging professionals that'll allow you into different networks, by applying to different incubators or accelerators that'll get you into that next step. There are, at more than any other time in the world, there's more access to different networks. The other thing, you mentioned consumer products. So if you're talking about a consumer products company, and if you have something that's describable, that you're not worried about putting out there for the public to see that you're doing it, another way is to gain market traction through using non-equity crowdfunding options like Kickstarter and the like.
Sometimes when, my invention is patent pending,
Okay.
so, sometimes you get worried about that somebody could see your idea on a Kickstarter or something like that, and they could maybe, when you don't have the capital to fight against somebody that's already taking your idea, it's a nervous thing about, intellectual property, because consumer products are very, it's a cutthroat business sometimes.
Yeah, fair enough. I mean, look, you talked to your IP lawyer about, so whether you have an issued patent or patent pending, it sounds like you're going to be in the same position, because your concern isn't that you don't have it protected. Your concern is that you can't afford to protect it.
Right.
Yeah.
And so that's kind of.
So that, I mean, but at some point, unless you're going to build the thing up in kind of in stealth mode for some period of time, at some point you're going to have to show the world what you're doing.
Yeah.
Are you seeing much activity in the crowdfunding, the more, the Reg A Plus and the new flavors?
Yeah, so-
Accepted in Connecticut.
Yeah, I mean, I'm seeing a lot in the news about Reg A Plus and people trying to do coin offerings and different different blockchain technologies through Reg A Plus. But I don't know about you. You mentioned it earlier. I'm not sure if you've seen successes being able to do that in the U.S., because I haven't really found a good way to do that. I mean, outside of the blockchain markets, I'm not seeing a ton of people using Reg A Plus right now, and the more kind of the crowdfunding, like the Jobs Act, non-accredited investor crowdfunding, that from what I've seen has been pretty dead. It's been mostly social ventures and breweries that seem to be utilizing that.
And there's a
The
problem
one-
with that? Breweries?
I don't have a problem with it. It's good for more breweries the better. And we represent a couple of them, so I'm okay with it. But no, I think in terms of the crowdfunding, the one that I think has really had the biggest impact is the 506c, the general solicitations of accredited investors. I mean, that's really opened up an ability through different portals for people to go out and raise big bucks from financing sources that they couldn't before. But what I'll say about that is you should go in with your eyes open, because I've got a lot of clients who don't realize they've done it. They think, oh, okay, I can just post something on the internet that says I'm raising money, but what they don't realize is they've just taken away their ability to do a true private placement and not have to jump through some of the hurdles of 506c, like the one Doug mentioned earlier, which was talking about getting your accreditation approved and verifying the accredited investor and not just doing it through your networks. I've had clients that have lost the ability to rely on that because they registered with a crowdfunding portal.
If I were to start a management company and bring in 10 investors at $50,000 apiece, so $500,000 to a university project, pursuant to the 506c, what might some of the other compliance issues be?
Well, that's a big question. I'm going to stick to just the fundraising component. You want to raise money for a venture, you need to, anytime you're selling a security or issuing a security to anyone, you need to do it in compliance with securities laws.
Oh, really? Even if it's
Yep.
even if it's only 10 investors
Yeah.
with
Now,
506c,
now
you have to comply.
the default rule is without any kind of exemptions from registration is IPO. You have to do a registered offering. Now, obviously, when you're doing the financing you're talking about, you're not going to do an IPO. You're not going to file a registration tape with the SEC. So there's plenty of exceptions that you can rely on. What you're talking about, you're talking about is one of the rules where there's an exemption, and that's 506c, and that's going to allow you to do a general solicitation of accredited investors on a defined portal where you verify the accredited nature of the investors and jump through a bunch of hurdles. I don't know where it currently sits, but at one point there was going to be a requirement for different levels of financial disclosure as well on those portals, but I'm not sure if it was ever formally passed. Sorry.
Yeah, could you say a few words about the difference between a 504 and a 506B, something like this?
Yeah, so the difference
similar.
between the B and the C, so the B and the C allow you to raise as much money as you want from accredited investors.
I think the 504 might be limited to $5 million.
So the 504 is limited in the amount of money. 506, you can technically bring in a certain number of non-accredited investors, except we usually recommend against bringing in non-accredited investors because there's no real defined rules around how much disclosure you need to provide them. The difference between the B and the C really comes down to whether or not you're doing it through your network and really doing it in a traditional private placement format, or you're doing it to the public and you're reaching out into different networks.
So if we're in touch with 10 investors,
Yeah.
we can put up 50, we're covered.
Yeah.
Just give the investors a private placement memo, tell them what conditions their holding is going to be.
So in your hypothetical situation, I'm not providing legal advice right now.
Okay.
I need to know a lot more about the situation.
Okay.
But yeah,
I'll get your card.
Yeah.
Where's it going to live?
I'll give you my card. Anyone else have any questions?
Yeah, pretty much my background is I can design everything I use SolidWorks, and I have a machine shop.
Mhm.
Where I have people working for me, but I can do all the work because I taught them all how to do the work. So I could produce a prototype that one item would have a market of tens of millions. And I could create a product that it already works.
Okay.
The other one,
Your design shop, do you own it or are you?
yes,
Okay. And all the people that work for you have assigned the IP that they're developing as a work for hire?
all the equipment is mine. I share a shop with a friend
Mhm.
that used to work for me in my own shop.
Okay.
So, and the other one, I have a throwaway disposable unit, just not including the applicator. They're using it probably in the neighborhood of several hundred million uses a year for each unit that would be thrown away in this country alone. The issue is I can get a patent for this country, but with those high volumes, being the market is pretty high. The issue would be on a one-person show.
Yep.
So I would need to get a team to put together, and that would be outside of my area of
Yep.
expertise. Is there how do you go about getting all those people in the right place?
Yeah, so I mean, you really what you need to do is, well, so it's, to the extent you want to take this idea and spin it out into a company for someone to develop or a product for someone to develop and sell off, I think you need to figure out who, you know, what types of resources that you need. I mean, from a development perspective, from a business perspective, from a financing perspective, identify those needs, and then go looking for money to fund it, or looking for somebody who, so if you have had money to fund it, and then you had somebody who can take the idea forward that you'd pay a salary to, that would work. I mean, another way to do it is to stumble into finding someone who's willing to license or buy that idea from you. But you have to be careful as to how you explain that idea to people.
Right, yeah. Lost our shirt doing that in
Yeah.
the past. I mean, oh God.
I mean, the way I think, you know, you have to, it would be helpful for you to meet some people that have done exactly what you're trying to do, not necessarily from your position, but people who've really built the product, and figure out a way to partner with them in some way.
I mean, there's nothing out there that comes close to it. You know, one thing we did about 30 years ago, we had a company out in Colorado, small startup, and we created people that wear oxygen masks. And what was being used at that time was a continuous flow. So if you're breathing out, you're losing it. So we came up with an oxygen demand system so that they would double practically the life of their bottle. And now it's used in everything for the portable units. But we had it stolen from us.
Yeah, so look, you'd have to be careful about who you'd share your idea with, and you'd have to do it under a non-disclosure agreement, and you'd want to make sure that you've filed for IP protection before you start sharing it with anyone. But there are probably people in this room that have taken an idea at that stage and turned it into a product and built a company around it. And it's not, I understand what you're doing has never been done before, but the concept of what you're doing and the path that you're taking has been done before. And you can either meet people through networking, or you could align yourself with an accelerator program or an incubator program. But I don't think it's an impossibility by any means. It's just a matter of partnering with the right people. If you feel really ambitious about it and you want to do what I described earlier, which is kind of set out, you know, who are the different people that I would need to have in a team that can take what I have here and build it here, and maybe that's a corporate lawyer, a patent lawyer, a business advisor, a developer in whatever area that you're in, and somebody who's raised capital in the past, and figure out what that would cost you to have.
Maybe one more question.
Sure, yeah. Anybody else?
I have two minutes.
No, thanks. Advice for founders, vehicle strategies to help maintain control and reduce probability of losing losing liquidity over time. When do you start that? Is that a pre-seed stage? Is that what? So what?
So
advice can you offer?
there's some tricks that people use that usually get undone when investors come in because they negotiate against them. There's like this thing called founders preferred stock, things like that. But at the end of the day, it's a matter of when you're taking on those investment dollars, what deal you're going to cut with your investors and what's going to be important to you at that time. And whether you're willing to become heavily diluted, or you're willing to give up control, that's a question that you're going to have to ask yourself as to what you're going to do. But to me, the primary driver shouldn't be figuring out how to avoid giving up control and dilution at that next step. It should be trying to figure out how to pick the right partner. So when it's all said and done, that pie becomes so big that it doesn't matter what the dilution was. Because I'd rather have 10% of $1 billion than 50% of 100. So but that's the key to it in the end, from a dilution standpoint. And from a control standpoint, yeah, look, you're not going to start a company because you want to be bossed around by some VCs. But if they're giving you enough money, where they're going to have a say in what you're doing, and they're the right partners, and they've done this before, and they've taken someone forward. I've taken companies forward and watched them be built, and they can make introductions to the kind of people that you're going to need, and they're the right partners. Then giving up that control so you can focus on building the technology or doing what you're good at isn't so bad. I mean, at the end of the day, most people aren't everything. Most inventors aren't also great financiers. I mean, there are exceptions to that, but I'm not personally. I personally wouldn't bet on. I wouldn't bet on myself being good at different things that I don't have experience doing. I mean, I mentioned earlier my own practice. We've got a portfolio of clients, so I try not, when I meet a new potential client, I want to look somebody in the eye and realize that they're a reasonable person that is going to be hardworking and want to do things and take a company forward, and they're a client that I'm going to want to work with. But what I try not to do is bet on their invention and bet on their idea, because I'm not a venture capitalist.
I hope you'll all join me in thanking the speakers. Next month, we've got, I'm going to butcher this name, Professor Linda G. Bauer. She's a professor of law from University of Connecticut, co-director and assistant clinical professor of the Intellectual Property and Entrepreneurship Law Clinic. And she'll tell us all how we can apply for patents using their clinic, essentially for free, plus or minus the fees that you have to pay to the patent office. So I've used their services before, and they're great. So as long as you're not in a terrible hurry, because they have students doing the work, but the students are supervised by professors, and so she'll tell us all about what they do over there. They're on the other side of the state somewhere, over in Stores. So thank you all for coming. There may be some people who want to go out for a bite to eat afterwards. I don't know if there's anybody here like that. Raise your hand if you are. No? Yes? One person only? Well, if you're interested, you know where Penny's is, so you can follow Bob here, and he'll take us to Penny's. And I hope to see you next month. Thank you for coming.
Thanks, Doug.
Thank you.
Thank you. Excellent.
Yeah, we're poking around with the ICO and we're going all over the place and following regs.
Accuracy.
Oh, okay.
Yeah.